Knowing when to exit is the hardest skill in trading, and Jesse Livermore mastered it like no one else. In this video, you'll discover how he read market behavior to sense when a move was nearing its end, how he used volume spikes, emotional extremes, and subtle trend shifts to guide his exits, and how those same principles can help you protect profits and avoid devastating reversals today. Because every trader can learn how to enter, but only the wise ones learn when to leave. That's the real art. That's what separates survival from success. Anyone can hit the buy button. Anyone can jump into a chart that looks promising. But the moment profits start appearing, that's where the real test begins. The heart starts racing, logic gets blurry, and a strange mix of fear and greed takes over. Fear of losing what's already gained. Greed for a little more. And in that hesitation, in that single flicker of uncertainty, everything starts to unravel. The candle that once glowed green starts to fade. Momentum slows. The chart begins to whisper something most traders ignore: it's over. But they hold on, they freeze. They watch profits disappear, blaming the market for what was really a lack of discipline, the inability to exit. Jesse Livermore didn't play that game. He wasn't just a trader, he was a strategist of emotion. He understood that wealth isn't made in the entry, it's built in the exit. His greatest strength wasn't his predictions, but his patience. He didn't chase tops or bottoms, he listened to what the market was saying. When volume began to scream and excitement filled the air, Livermore didn't celebrate. He prepared. Because to him, euphoria was the signal, not the reward. The louder the crowd cheered, the clearer his exit became. Picture the scene: the stock ticker is rattling across the exchange floor, green numbers glowing, traders shouting, phones ringing off the hook. It's chaos, the kind of chaos that makes everyone believe they're witnessing the next big boom. But amid that noise, Livermore stands calm, watching. To the untrained eye, it looks like an opportunity. To him, it looks like exhaustion. The market is tired. The move has stretched too far too fast. Volume is peaking. And in that moment, when everyone else is buying more, Livermore quietly begins to sell. He's not reacting to emotion, he's responding to rhythm. Because the market, he believed, has a heartbeat, and he could hear it slowing down. This mindset was what made Livermore extraordinary. He didn't think like the crowd because he didn't feel like the crowd. While others chased validation, he chased clarity. He knew that exits are not about timing perfection. They're about reading behavior. He once said, "I don't sell because I think the market will fall. I sell because I see that the rise is over." It's a small difference in words, but a world of difference in results. That's the mindset we're diving into today, the one that made Livermore not just a trader, but a master of the cycle, understanding when to press and when to pause, when to let profits run, and when to step aside before the music stopped. He studied volume not as numbers, but as emotion. Every surge told him a story, every breakout screamed enthusiasm, every climax whispered danger, and when the market's voice grew too loud, that was his cue to walk away. Most traders never reach that level of awareness. They spend years mastering entries, studying indicators, memorizing setups, yet still lose because they can't do the one thing that matters most: exit when it's time. They wait for confirmation that never comes, they hope for one more push, and by the time they act, it's too late. Livermore understood that hope is the most expensive emotion in trading. It costs more than any loss ever could. That's why he built rules, strict, emotionless, mechanical rules, to tell him when enough was enough. You see, Livermore's world wasn't about greed or excitement. It was about control. Control over himself. Control over timing. He used tools that every trader has access to today. Volume, trend lines, market sentiment. But his real weapon was discipline. He planned his exits before he entered a single trade. He knew the price level where he'd take profits, the signal that would make him reduce exposure, and the exact behavior that told him the move was fading. There was no guesswork, no chasing, no second guessing. His exits were procedural, not emotional. And that's what this entire journey is about. Taking that legendary wisdom and turning it into something modern, practical, and actionable. Because even though the market has changed, human behavior hasn't. The same greed, the same fear, the same hesitation that ruled traders in 1920 still rules traders today. Livermore's lessons aren't history, they're psychology. And if you can master that psychology, you can change your trading forever. So as you watch this video, I want you to imagine your next winning trade. Picture it in your mind, the perfect setup, the entry that feels right, the price moving exactly as you predicted. Now ask yourself, do I know where I'll exit? Not just where I hope to, but where I've decided to. Because that answer, that single point of clarity, will decide whether your profit becomes reality or regret. Livermore understood this better than anyone. He used to say that the market rewards the disciplined, not the daring, and his exits were proof. When the crowd screamed buy, he sold. When the crowd panicked, he waited. His power came from patience, from being comfortable walking away while others stayed addicted to the action. He built his fortune not by always being right, but by knowing when to stop being greedy. That's what made him timeless. Because exits, not entries, are what separate the gamblers from the professionals. And the professionals know that in trading, the finish line is more important than the starting point. By the end of this video, you'll learn how to see the market like Livermore saw it. Through the lens of rhythm, emotion, and discipline, you'll understand how to use volume spikes, trend exhaustion, and your own emotional signals as warnings instead of invitations. And you'll realize that the moment you master your exit, you've already mastered the market. So as the charts flash from red to green, and Livermore's portrait slowly fades into the sound of a ticking clock, remember this: the entry gets the glory, but the exit builds the fortune. Anyone can open a trade, but only the disciplined know when to close it. And that single decision, is what separates those who survive from those who truly succeed. Because in the end, the market doesn't reward excitement, it rewards patience, it rewards clarity, it rewards the trader who knows that sometimes the smartest move is to stop moving. Every trend ends the same way, not with a crash but with exhaustion. Jesse Livermore understood this truth better than anyone. He didn't wait for a headline or a sudden reversal to tell him the move was over. He watched the market breathe. He listened to its rhythm. Expansion and contraction, confidence and hesitation, greed and fear. Most traders see price. Livermore saw behavior. And when that behavior changed, he knew the trend's heartbeat was slowing down. He called it trend exhaustion. And it was his first signal to start preparing for an exit. He noticed subtle signs long before the charts showed weakness. Momentum slowing even as prices climbed. Volatility increasing near the top. Highs that looked strong but failed to hold. And a tone shift in the crowd's excitement. He wasn't just studying the market, he was reading its mood. When enthusiasm reached its peak and energy began to fade, he knew the move was aging, even if the candles still glowed green. You see, Livermore believed markets move like lungs. They inhale with expansion and exhale with contraction. Every trend breathes, but most traders forget that. They fall in love with the inhale, thinking it will last forever. They watch prices stretch higher, convinced it's just the beginning, when in reality, it's the final gasp before the slowdown. And when the market exhales, they panic. Too late, too emotional, too attached. Livermore never made that mistake. He didn't chase the breath, he timed it. He used to say, "A move that can't go higher won't." Simple words, but behind them was profound wisdom. He understood that exhaustion isn't a crash, it's a slow fade. It begins when the market stops responding to good news, when strong earnings or bullish data no longer push prices up, when traders begin buying just because everyone else is. That's when smart money starts leaving. And Livermore was always part of the smart money. He would watch the tape for small clues, rallies that lost follow through, highs that couldn't stick, volume spikes that led nowhere. He knew that when energy starts fading, effort increases but result decreases. That's the silent warning before every reversal. The amateurs see price moving and assume strength. Livermore saw price struggling to move and recognized weakness. That's what made him different. He understood that the end of a move doesn't announce itself. It hides behind excitement. It tempts traders to hold just a little longer, whispering, "It'll bounce again." But the bounce never comes. Because exhaustion is invisible until it's too late. That's why Livermore exited before it was obvious. He trusted behavior more than opinion. He watched how the market reacted, not what people expected. Most traders hold through the contraction because they mistake exhaustion for a pause. They see the slowdown and call it consolidation. They see the fading highs and tell themselves it's just resting before the next leg up. But Livermore knew better. He knew that when a market needs rest, it's no longer the time to hold big positions. The real professionals lighten up when things look strongest, because that's when risk hides behind illusion. He didn't predict tops. He recognized them. When volume began to dry up, when the candles showed long upper wicks, when momentum indicators flattened while price pushed higher, he saw a tired market gasping for air. That was his cue. Not to panic, not to sell everything, but to start scaling out, reducing exposure, protecting profits, and preparing for what he called the turn. Livermore's brilliance was in his calm. He wasn't emotional about exits. He was strategic. He knew that exiting too early meant missing a little profit, but exiting too late meant losing a lot more. So he built rules, not opinions. If momentum slowed for too long, if highs failed to break cleanly, If price began to hesitate after strong runs, he acted. Because he knew that discipline earns more than prediction ever could. The market, to Livermore, was a mirror of human behavior. Every spike was hope, every dip was fear. And when hope became too strong, when it drowned out caution, that's when he knew exhaustion was close. He didn't need indicators or fancy tools. He needed awareness. He needed to feel when the crowd had gone too far. That was his edge. So what can you, a modern trader, learn from this? The same timeless truth: the end of every move gives signals, if you know how to listen. Fading highs, lower volume, long upper wicks, shrinking follow through. These are not random patterns. They're whispers of fatigue. They tell you the market is tired, the buyers are losing strength, and the momentum is slipping away. The moment you see those signs, it's not weakness to take profits, it's wisdom. Because Livermore's rule was simple: never let a tired market take your gains away. He believed that exits are not about perfection. They're about protection. Every time he exited on signs of exhaustion, he kept his capital safe and his mind clear. And that clarity allowed him to strike again when the next wave appeared. That's what most traders miss. Exiting early doesn't end opportunity, it creates it. Because when your money and focus aren't trapped in a fading move, you're ready for the next one. That's how Livermore stayed ahead. So the next time you see a strong trend slowing down, remember Livermore's wisdom. Don't fall in love with the move. Watch the behavior. Watch the heartbeat. Is volume fading? Are highs struggling to hold? Is momentum hesitating even as prices rise? Those aren't small details. Those are your warnings. They're the market's way of telling you it's tired. Every trend, no matter how powerful, runs out of breath. And if you can learn to sense that moment, not through panic, but through observation, you'll protect not only your profits but your peace. Because Livermore's true genius wasn't in how much he made, but how much he kept. He treated every trade like a living thing, strong in the beginning, mature in the middle, and fragile at the end. And when it grew fragile, he let it go. Every trend ends with exhaustion. Every market, no matter how wild, eventually slows. The amateurs stay until it's too late. The professionals listen and leave quietly. That's how Livermore built his fortune, not by holding forever, but by knowing when forever was over. Jesse Livermore used to say that the market doesn't just move on numbers. It moves on emotions. Prices rise and fall not because of pure logic, but because of how people feel about them. Fear and greed, hope and despair, overconfidence and panic. These are the real forces behind every candle on the chart. And for Livermore, that was the ultimate indicator. He didn't need a crowd of analysts to tell him what was happening. He just had to feel the crowd's emotions shifting. When traders started bragging, cheering, and rushing in like a stampede, that's when he quietly walked away. He believed markets speak through emotion. Every wave of buying and selling carries a psychological fingerprint. In the early stages of a move, emotions are cautious, traders are curious, testing, and skeptical. As the move progresses, that skepticism gives way to excitement, then confidence, and finally euphoria. And that's the danger zone. Because once emotion replaces logic, the market's clock starts ticking. The same passion that pushes price higher soon burns itself out. That's when Livermore knew the move was ending, not because of data, but because of behavior. He once said, "The public is right during the trends and wrong at both ends." That simple line carried the weight of his philosophy. The crowd creates the middle of the move, the profitable part, but it also destroys itself at the extremes. In the beginning, they're too afraid to buy. In the end, they're too afraid not to. And that fear of missing out, that desperate rush to join the party, was Livermore's signal to leave it. When the crowd got loud, Livermore got out. You see, he didn't trade against people. He traded against their emotions. He watched for overconfidence like a hunter tracking sound. He knew when people stopped thinking and started reacting, when conversations shifted from analysis to celebration, when every trader on the street started calling themselves a genius, when barbers, clerks, and taxi drivers began giving stock tips. That's when he knew the top was near. Because true professionals never cheer, they calculate. The cheering always belongs to the crowd, and the crowd always arrives last. Livermore understood that markets move in emotional cycles. It begins with disbelief, builds through optimism, and peaks in euphoria. Then comes anxiety, denial, panic, and finally despair. He knew where he wanted to enter, early, when others were uncertain, and where he wanted to exit, when confidence became a disease. He called that point the emotional climax. It's when everyone believes nothing can go wrong, when buyers outnumber sellers not by logic but by emotion, when prices rise just because they're rising. That's not a strength. That's madness dressed as momentum. So how did he use this insight? By turning sentiment into his exit signal, he treated the crowd's emotion as an inverse indicator. When optimism hit extremes, he looked for warning signs in price behavior, exhaustion candles, slowing momentum, parabolic curves flattening. But even without charts, he could sense it, because emotion leaves clues everywhere, in headlines, in the way traders talk, in the energy of the market itself. He often said that he could feel when the market was too full, when too many people were on one side of the trade. That imbalance was unsustainable. It didn't matter how strong the story sounded or how positive the sentiment looked. Once the last buyer entered, there was no one left to push prices higher. And that's when gravity took over. Livermore never waited for that fall. He left before it began. That's why his exits looked early to others, but they were right on time. It's a lesson that still applies today. You can have every indicator in the world, every piece of analysis, every advanced chart setup. But if you ignore emotion, you'll still lose. Because markets don't move because of what should happen. They move because of what people feel. And when emotion becomes the market, logic disappears. That's your warning. Think about how many times this has happened in your own trading. You see a strong move, you hesitate, then you watch it run higher. You feel left behind. You tell yourself you'll wait for a pullback, but it never comes. Finally, you can't resist. You buy. The very next day the move stalls, price reverses, and suddenly, what felt like a sure win becomes pain. That isn't bad luck. That's emotional timing. You entered when everyone else did. When logic was gone and emotion ruled. Livermore's wisdom was to flip that moment on its head. When everyone's rushing in, that's when you start walking out. He knew that euphoria was always the final stage of a move. Not because the fundamentals change, but because human nature doesn't. The market's rise feeds excitement, excitement fuels greed, and greed blinds rationality. It's a cycle that never ends, because human emotion never changes. That's why Livermore didn't need to predict the future. He just needed to understand people. The market is human nature displayed in numbers, and if you can read that, you can read everything. He used emotional cues the same way others used technical ones. If he saw traders boasting about their profits, he started tightening stops. If he heard too much optimism in the news, he began trimming positions. If he felt the market's tone become celebratory instead of cautious, he knew the end was near. That emotional awareness was his edge. So how do you apply this today? Simple. Treat sentiment as a mirror. When everyone's fearful, opportunities are hidden inside panic. But when everyone's confident, danger hides behind optimism. Watch for the language people use. Are traders saying, "I think" or "I know"? Are they analyzing or just cheering? Are social feeds filled with questions or with victory posts? The more confident the crowd sounds, the closer the end is. Livermore never saw emotion as noise. He saw it as information. He used it as a map. When the crowd grew quiet and fearful, he prepared to buy. When it grew loud and euphoric, he prepared to sell. It wasn't complicated. It was rhythm, and he followed that rhythm with almost mechanical calm. That calmness was his secret weapon. Because when everyone else was emotional, he stayed rational. When others were excited, he was observant. When others were panicking, he was patient. He didn't let emotion dictate his timing. He used emotion to time everyone else's. That's the essence of Livermore's genius. He didn't predict the market, he read the crowd. So remember this: every time you feel the urge to buy just because you don't want to miss out, stop. Step back. That's your warning sign. That emotion, that sense of urgency, is exactly what Livermore used to avoid. The moment the crowd stops thinking and starts feeling, the top is forming. And the moment logic gives way to euphoria, the professional quietly exits. Livermore once said that markets are never wrong, opinions are. And opinions are born from emotion. If you can see when emotion becomes the market, you can see the end of the move before it arrives. That's not luck. That's awareness. And awareness is the most powerful trading edge there is. Because at the end of every rally, it's not the charts that signal the turn, it's the people. Their excitement, their confidence, their noise. When that noise grows too loud, that's your silence cue. That's when you exit. That's when you protect what you've earned. And that's when you do what Livermore did best. Step away before the crowd realizes it's already too late. When you truly understand the market, you realize it's not numbers that move prices. It's emotion. Jesse Livermore used to say that the market speaks through behavior long before it shows through price. He didn't watch charts to predict, he watched people. Every surge of greed, every wave of fear, every rush of excitement. To him, those were the real signals. The market story was written not in candles or lines, but in the crowd's psychology. He understood something most traders still miss today: when emotion takes over, logic disappears, and that's exactly when the move is near its end. He believed that as long as traders were cautious, uncertain, and skeptical, the trend had room to run. But the moment that skepticism turned into blind confidence, when everyone suddenly believed profits were guaranteed, Livermore knew danger was near. The crowd that once hesitated to buy now stampeded into trades, chasing what they believed was easy money. That was his cue. While others celebrated, he quietly prepared to leave. He once said, "The public is right during the trends and wrong at both ends." Meaning, the average trader usually joins the move too late and leaves too late. Livermore learned to exit when others finally felt comfortable, because that's when comfort turns into complacency. Think about your own trading. How many times have you seen the market roar upward? Headlines screaming about record highs, social media filled with screenshots of profits, everyone suddenly calling themselves an expert. That's not confidence. That's euphoria. And euphoria, in trading, is fatal. Livermore would often describe that phase as the market's emotional climax, the point where logic is replaced by greed, where no one wants to miss out, and where everyone starts believing. This time is different. He knew better. Every different market ends the same way, with pain for the ones who stayed too long. He trained himself to recognize emotional excess as his signal to act. When conversations in brokerage offices turned from caution to celebration, when traders stopped managing risk and started bragging about profits, Livermore knew the end was near. He didn't need indicators flashing red or green. He just needed to see the crowd lose its fear. Because fear, ironically, is what keeps traders safe. The absence of fear is not strength, it's blindness. Livermore's genius was his detachment. He didn't need to be right, he needed to be early. He sold into strength, not weakness. When others were shouting, "Buy," he was already calculating his exits. To him, emotion was the ultimate technical indicator. You could read it in the tone of the news, in the chatter of the trading floor, even in the way price behaved. Fast, erratic, stretched too far. Every bubble has the same heartbeat: rising optimism, public participation, and a final burst of madness before silence. Most traders ignore these signs because they're emotionally invested. They want to believe that this trade will be the one that never ends, that this rally will go on forever. But Livermore had seen too many markets to fall for that illusion. He would often remind himself, the market is never wrong, but opinions often are. He exited not because he feared missing profits, but because he respected the cycle of emotion. What goes up too fast always comes down just as hard. This lesson is brutally simple but deeply powerful. Exit when euphoria replaces analysis. When traders stop asking, "Is this a good trade?" and start saying, "I don't want to miss out," that's the bell ringing. That's the moment to start reducing positions, tightening stops, and protecting what's already yours. The emotional high of the crowd is your silent warning that the top is near. Livermore's emotional discipline was built on observation, not prediction. He didn't need to guess the top. He recognized it when the market stopped behaving rationally. When the volume surged but progress slowed. When buyers became desperate instead of strategic. When charts looked parabolic and discussions became arrogant, he acted. That's why he profited while others panicked. Even today, this principle remains one of the most accurate signals any trader can use. Sentiment is data. The crowd's mood is measurable. You see it in headlines, in social media chatter, in the tone of financial news, even in your own emotions. The next time you feel a wave of excitement, that rush to buy just because others are, pause. Ask yourself, am I trading my plan or following the crowd? That single question can save months of profit. Livermore mastered the art of reading emotion not to predict markets, but to protect himself from them. He turned detachment into an edge. He never argued with the market, he listened to it. And when it started shouting, when the crowd's noise drowned out reason, he walked away. That's why he survived every storm. Because the market rewards those who can act while others react. Remember this truth: the moment the crowd feels unstoppable, the top is near. The moment fear turns into greed, the cycle turns. The public will always arrive late to the party, but you don't have to. You just need to recognize that emotion, not logic, ends trends. So when everyone else starts celebrating, that's your cue to get cautious. The crowd's euphoria is your exit signal. Livermore once wrote, "A man must believe in himself and his judgment if he expects to make a living at this game." That belief wasn't arrogance. It was independence. Independence from noise, from hype, from emotional contagion. To trade like Livermore is to stand apart when everyone else moves together. Because in the market, your greatest profit often comes from having the courage to leave while others are still cheering. Greed is the invisible enemy that every trader faces, not in the market, but in the mirror. Jesse Livermore once said, The time to sell is when you still want to buy more. At first, that sounds backward. Why would you sell when everything looks perfect, when the trend feels unstoppable? Because that's the moment when emotion, not logic, is driving your decision. And emotion has destroyed more fortunes than bad trades ever will. The market doesn't punish you for being wrong, it punishes you for staying wrong, and greed is the voice that keeps you trapped when you should be free. Livermore understood something that few traders truly grasp. Even today, success in trading isn't about predicting the market, it's about mastering yourself. The charts don't control you, your impulses do. And greed is the most seductive of them all. It whispers, hold a little longer. You're almost at the top. Don't sell now, wait for just one more push. But that one more is where most traders give back their hard-earned gains. It's a universal story. The same mistake replayed by every generation of traders. You tell yourself you'll sell when it hits the next level, but when it gets there, you move the goalpost again. Greed never lets you stop. It convinces you that logic is fear, that discipline is weakness. You think you're being patient, but you're just being emotional in disguise. The professional mindset flips this completely. Pros don't think about how much more they can make, they think about how much they can protect. They trade to survive, not to prove they're right. Livermore built and lost fortunes multiple times, but his lessons came down to discipline. He learned that greed is disguised as hope, and hope has no place in trading. When your screen flashes green, your heart races. You start calculating what another 10% move could mean. You imagine the profits doubling if you just wait one more day. That's when greed takes control. Not because the market tricked you, but because your mind did. The difference between an amateur and a professional is what happens at that exact moment. The amateur says, I'll just wait a little longer. The professional says, this is enough. I'll take my profits and move on. Greed is never satisfied. The moment you give it an inch, it takes a mile. It convinces you that patience equals profit, but that's not patience, it's paralysis. You freeze, you hesitate, and before you know it, the market reverses. What was once a winning trade becomes a regret. You scroll back to your earlier profits and think, if only I sold there. But that's not bad luck. That's a lack of a plan. Discipline begins before you even enter a trade. Every exit should already be decided. You should know where you'll take profits, where you'll reduce size, and where you'll cut the position entirely. Livermore believed that planning the exit was more important than planning the entry. Because every entry is just a promise, but the exit is the reality. The truth is harsh but liberating. You will never sell the exact top. You will never exit at the perfect price. And that's okay. The goal isn't perfection, it's consistency. Professionals sell into strength, not after it's over. They scale out as price extends, taking partial profits as momentum slows. That's how you stay calm when others panic. You're not gambling for the last cent. You're securing your gains while the crowd is still greedy. Think of it like climbing a mountain. When you're halfway up, you can see the goal, the peak. But once you reach it, there's only one way left to go down. Most traders don't realize when they're standing at the peak because greed blinds them. They keep climbing until gravity does the work for them. A sudden fall that wipes away everything. Livermore avoided that by respecting his own emotions. When he felt too confident, too comfortable, he knew he was in danger. He once said, a man must believe in himself and his judgment if he expects to make a living at this game. But he must also have the discipline to admit when he's wrong. That discipline applies to profits too. Because the greed that prevents you from selling is the same emotion that prevents you from cutting losses. It's just dressed differently. Every great trader builds a rule around greed. One of the simplest yet most powerful ones is this: take profits when you're still happy with them. Not when the chart forces you, not when the market punishes you, but when you choose to. The act of deciding when enough is what defines professional maturity. Imagine you're in a trade that's up 30%. You've already hit your target zone, but the price keeps moving. Your emotions say, ride it out. But your plan said, sell here. What do? Most traders break their plan, and that's the exact moment they lose control. Livermore would have taken partial profits, maybe sold half, and let the rest run with a trailing stop. That way, if it keeps going, great, he's still in. But if it reverses, he's already secured a win. That's how pros think. They make peace with incomplete profits in exchange for complete control. That mindset is rare because greed thrives in uncertainty. It feeds on your imagination. You start projecting? What if this goes 10x? Or, what if I just wait another day? But trading isn't about what ifs. It's about what it is. Every decision should be built on evidence, not emotion. Livermore's discipline came from observation. He studied how greed made people irrational. He saw how the crowd always pushed too far, and he made money by doing the opposite. He didn't just analyze prices. He analyzed psychology. He understood that markets rise on emotion and fall on emotion, and greed is the fuel that drives both. If you want to master greed, you need two things: structure and detachment. Structure means having a written rule, not a vague intention. For example, when price extends 10% beyond target, sell 25% of the position. Detachment means you follow that rule no matter how exciting the trade feels. The more emotional the market becomes, the calmer you must be. Greed will always test you most when you're winning. It's easy to be disciplined after a loss, because pain teaches humility. But profits make you feel invincible. That's when the danger begins. The brain releases dopamine, the same chemical that fuels addiction. It tricks you into thinking that the next move will be just as good, and that's how traders give back everything. Livermore knew that real success wasn't measured by making money, but by keeping it. He would often say that big profits are made by sitting, but only when sitting is part of the plan. That means you can hold when there's logic behind it, not because greed tells you to. If your system says the trend is still healthy, then sitting tight is discipline. But if your system flashes warning signs and you ignore them, that's greed pretending to be patience. Livermore's approach to discipline wasn't just financial. It was spiritual. He believed trading was a mirror of your mind. If you were reckless in life, you'd be reckless in trades. If you were greedy in business, you'd chase tops in markets. Every trade, he said, was a test of character, and greed was the one test that humbled even the greatest. To avoid the greed trap, start by redefining success. Instead of asking how much can I make, ask how much can I keep. Celebrate well-executed trades, not lucky ones. Reward yourself for sticking to your plan, not for catching big wins. Over time, your identity shifts from being a gambler to being a strategist. That's when you begin to think like Livermore, calm, detached, and deliberate. Remember, the market will always tempt you. It will always show you what you could have made if you just held a little longer. But wisdom lies in realizing that you're not here to win every move. You're here to win the long game. Protecting capital, respecting rules, and mastering greed. That's what keeps you in the game while others burn out. Livermore didn't need luck to make millions. He needed discipline to keep them. And that's the lesson that still echoes today. It's not the market that takes your money. It's your inability to take it yourself. So next time you feel that whisper, hold a little longer. Remember what Livermore said, the time to sell is when you still want to buy more. That's not fear talking. That's wisdom. That's control. And that's the mindset that separates those who trade for excitement from those who trade for freedom. The market is designed to exploit emotion. Every chart, every move, every sudden rally or crash is a test of control. The crowd reacts, the professional anticipates. And the difference lies in one small word: discipline. You can't control what the market does next, but you can control how you respond. That's what Livermore mastered. When others panicked, he observed. When others got greedy, he quietly took profits. His success wasn't luck, it was the byproduct of emotional balance. Each trade he made wasn't just about money, it was about mastery over himself. Every time he ignored the whisper of greed, he strengthened his edge. Every time he stuck to his rule, he bought another day of survival. And in trading, survival is victory. Most traders blow up not because they lack skill, but because they lack restraint. They chase highs, double down on euphoria, and confuse luck with genius. Livermore understood that the market rewards patience but punishes hope. The amateur hopes, the professional acts. The amateur wishes for more, the professional accepts enough. That difference, that quiet acceptance, is the foundation of longevity in trading. True power in the markets comes from detachment. It comes from looking at a sea of green and still being able to say, "That's enough for me." It comes from recognizing that greed never ends. It just changes its mask. One day it says, "Hold for more." Another day it says, "Recover your loss." Either way, it controls you unless you see it for what it is. Livermore learned this through pain, through loss, through the repeated cycle of rise and fall. He knew that every trader eventually meets their own weakness in the market. And for most, that weakness is greed. The market exposes who you are when money is on the line. It doesn't care about your opinions, predictions, or feelings. It only reflects your ability to stay disciplined under pressure. When you start trading, you think the challenge is to predict price movement. Over time, you realize the real challenge is to predict your own behavior when everything's on the line. That's what Livermore mastered. That's what separates professionals from dreamers. Because in trading, everyone learns charts, but few learn themselves. And until you do, greed will always win. The truth is, greed doesn't scream. It whispers. It hides inside your best trades, waiting for that one moment when logic fades. It doesn't want you to lose, it just wants you to wait. And in that waiting, you lose everything. The irony of greed is that it always feels logical in the moment. You convince yourself you're just being smart, patient, strategic. But deep down, you know, you're holding because you want more, not because your system told you to. That's the subtle difference that destroys accounts. Livermore said trading was the hardest way to make easy money, and he was right. Because trading doesn't test your charts, it tests your character. Every green candle is a temptation, every pullback a test of conviction, and every profit an invitation to lose control. The trader who learns to manage greed learns to manage himself. And once you do that, no market can beat you for long. So the next time you see a winning trade, remember this: profits are not yours until you take them. The market doesn't care about what you deserve, only what you decide. Take what's yours, protect it, and move on. Because in the end, trading isn't about making money, it's about keeping your mind clear enough to make the next right decision. Livermore knew that better than anyone. He wasn't just fighting markets, he was fighting himself. And that's the real battle every trader must face. Jesse Livermore traded in an era without screens, algorithms, or alerts. No candlestick patterns were lighting up in real time, no trading terminals blinking with color-coded signals. Yet somehow, he could feel the market breathe. He could sense the moment a move was ending, long before most traders even realized what had changed. Livermore's genius wasn't in technology, it was in clarity. He could see what others ignored: the rhythm, the emotion, the exhaustion. And while the tools have evolved, the truth hasn't. What Livermore mastered with instinct, you can now master with structure, if you use your tools with discipline, not dependence. That's the edge of the modern trader. We have access to the kind of data Livermore could only dream about. Every tick, every volume spike, every sentiment shift is visible at the click of a button. But data without discipline is just noise. Technology doesn't make you a better trader, it magnifies who you already are. If you're impulsive, it makes you faster at being impulsive. If you're patient, it makes you sharper. So the challenge today isn't finding better tools. It's learning how to use them the way Livermore used his instincts, with patience, precision, and purpose. Livermore didn't chase signals, he read context. He understood that every move had a story: build-up, acceleration, climax, and exhaustion. That same rhythm exists in modern markets, only now it's measurable. Moving averages, volume analysis, and momentum indicators can all act as the modern echo of Livermore's intuition. They don't replace his wisdom, they translate it into numbers you can act on. Start with moving averages. Livermore watched trends unfold by observing how the price behaved around its average pace. Today, we have that visualized through moving averages. A simple, yet powerful way to track the life of a trend. When a short-term average like the 9 or 20 date crosses below a longer-term one like the 50 day, it's often the first sign of exhaustion. The modern version of Livermore noticing that price can't make new highs. That crossover isn't just math, it's emotion turning. It shows that buyers are losing conviction and sellers are starting to press. Livermore would have loved that tool, not because it predicts, but because it confirms. It shows you when momentum shifts from strength to hesitation. Then there's volume, Livermore's favorite signal. He called it the market's heartbeat. To him, price without volume was a whisper. Price with volume was truth. He used volume spikes to sense climax, when activity became frantic, emotional, unsustainable. Today you can spot that same climax with volume divergence. When price continues to rise but volume starts to fade. That's the market's way of saying, the crowd's running out of breath. It's not a coincidence that tops often form when the biggest volume days happen near the end of a move. Livermore would sell into that strength, not after it, because he knew, the crowd's excitement is your warning bell. You can even automate that awareness. Volume-based alerts, momentum scanners, and divergence indicators can now show you what Livermore had to feel in real time. But automation means nothing if you don't act when it matters. That's the difference between knowing and doing. Livermore didn't hesitate when his signals appeared. He executed. He didn't argue with the market or hope for one last run. He respected the evidence. And that's what every modern trader must learn. Technology doesn't give you clarity. Discipline does. Momentum indicators like RSI's Relative Strength Index and MB are today's version of Livermore's emotional reading of the crowd. He could tell when a move was overextended, when enthusiasm had turned into mania. RSI shows that mathematically. When RSI climbs above 70, it's not telling you to sell immediately, It's telling you the crowd is emotional. Combine that with fading volume, long upper wicks, or hesitation candles, and you have a complete picture of exhaustion. Livermore used words like tired market. Today we call it overbought. The principle hasn't changed, only the language. But here's where most traders go wrong. They use these tools reactively, not proactively. They wait until it's obvious, until the chart screams reversal, and by then, it's too late. Livermore never waited for confirmation from the crowd. He acted on his own signals. He trusted his plan more than the noise. That's what separates a tool from a crutch. A tool supports your system. A crutch holds up your fear. Modern traders can build Livermore-style exit systems using automation. For example, you can create alerts that trigger when volume drops while price continues to rise. You can use moving average crossovers as mechanical confirmation. You can layer momentum indicators to identify when strength starts to weaken. Each piece adds structure, but the power comes from your consistency. Livermore's exits weren't emotional, they were procedural. Your goal should be the same. Make every exit a rule, not a reaction. Now, let's talk about scaling out. One of Livermore's favorite tactics in principle, even if he never used that modern term. He believed in selling into strength. In today's trading, that means taking partial profits as the trend extends. When your position is up significantly and the market is showing signs of exhaustion, you sell a portion, not because you're scared, but because you're respecting the law of diminishing returns. That simple act of scaling out turns chaos into control. It keeps you mentally detached and financially secure. Here's the beauty of it: modern platforms make this effortless. You can predefine take-profit levels, automate trailing stops, or even use AI-based risk systems to rebalance positions dynamically. But remember, technology can't save you from hesitation. It can only help if you already have the mindset Livermore lived by. Plan the trade. Trade the plan. He didn't improvise when the market got loud. He followed the structure. Let's take a practical example. Imagine you're long on a strong uptrend. The price has been riding above your 20-day moving average for weeks, volume is healthy, and RSI is stable. Suddenly, you notice the highs are still rising, but volume is dropping. RSI pushes above 70 and stalls. The short-term moving average starts flattening. You don't need a psychic prediction to know what's happening. The market is getting tired. That's your cue. Begin taking profits. Scale out 1/3 of your position. If momentum keeps fading and the 20-day crosses below the 50-day, exit completely. That's Livermore's principle, modernized. You're not reacting to emotion, you're responding to evidence. Now, combine this technical discipline with Livermore's emotional discipline, and you become unstoppable. Because while tools tell you what the market is doing, psychology determines what you do. You can have the best indicators in the world, but if you can't pull the trigger, they're useless. Livermore didn't need a computer. He needed clarity. And that's the message every modern trader needs to hear. You already have more power than Livermore ever did. But do you have his self-control? Clarity means understanding that every signal has a context. A crossover doesn't mean panic. A divergence doesn't mean disaster. They mean prepare. Livermore prepared like a general planning a retreat, calmly, strategically, without emotion. When he exited, it wasn't fear, it was precision. He'd already accepted that no one sells the top. His job wasn't to guess perfection, it was to protect profits. And that's what your exit plan should do. Give you structure to protect what's yours, while letting opportunity breathe. In modern terms, that means building layered exits. Your first layer, partial profit targets at logical resistance zones. Your second, trailing stops that follow structure, not emotion. Your third, full exit occurs when confirmation appears, like a major crossover or breakdown in volume. This system ensures you're never trapped by greed or fear. You're acting systematically, not spontaneously. But here's the deeper truth: Livermore's wisdom wasn't just about tactics. It was about temperament. He'd often say, a man must study general conditions to seize them so as to be able to anticipate probabilities. In today's world, that translates to using your tools as mirrors of probability, not prophecy. Moving averages don't predict the future, they help you interpret the present. Volume doesn't tell you what will happen next, it tells you what's happening now. Momentum indicators don't reveal tomorrow's top, they reveal today's tension. Your job is to connect those dots the way Livermore connected emotion, behavior, and price. The more structured your system, the calmer your mind. The calmer your mind, the sharper your exits. Because in the end, exits aren't about markets, they're about mastery. And mastery comes from discipline. Discipline to follow the plan when the chart looks euphoric. Discipline to take profits even when your heart says, hold just a little longer. Discipline to step aside when evidence turns, even if everyone else is still celebrating. That's how you turn Livermore's century-old wisdom into your modern edge. If Livermore traded today, he wouldn't chase headlines or signals. He'd build dashboards. He'd set alerts for volume spikes, divergence, and moving average breakdowns. He'd automate what he once did by instinct, not because he didn't trust himself, but because he valued structure. His real strength wasn't prediction. It was protection. He survived because he built systems that guarded him from himself. That's the lesson. Automation can't replace awareness, but it can reinforce it. You can't program discipline. You have to practice it. Your software can remind you when to act, but it can't decide for you. That's still your responsibility. And if you truly want to honor Livermore's legacy, don't just copy his tactics. Adopt his mindset. Livermore didn't win because he was smarter. He won because he was steadier. While others got emotional, he stayed procedural. He had rules for every move, and he followed them like law. That's what you can do today with the help of modern tools. Build your exit plan as a checklist, not a guess. Define your signals, your triggers, and your responses before the market even opens. When you combine Livermore's timeless psychology with today's automation, you unlock the best of both worlds. Intuition guided by data and discipline powered by technology. That's how you evolve from reactive trading to strategic execution. That's how you turn chaos into clarity. So remember, Livermore didn't need a computer. He needed clarity. You have both. You have real-time data, advanced platforms, back-testing systems, AI-driven scanners, everything he didn't. But none of it matters if you lack his patience and precision. Technology can make you faster, but only discipline can make you profitable. You don't need to be perfect, you just need to be consistent. Because in this game, survival is success, and consistency is compounding. Livermore's legacy wasn't built in a day, it was built through thousands of disciplined decisions. Every exit he made wasn't luck, it was control. Every profit he kept wasn't chance, it was choice. That's your edge today. Not a prediction, not emotion, but process. Build it, trust it, refine it. Because when you trade with structure, your emotions lose power. You stop reacting and start responding. You stop gambling and start executing. And slowly, trade by trade, you start doing what Livermore did instinctively. Exiting not with fear, but with confidence. And maybe, just maybe, that's what Livermore would tell you if he stood beside your screen today. Don't look for the perfect moment. Look for the clear one. Because clarity, not courage, is what makes a trader rich. Jesse Livermore mastered one thing above all, the art of knowing when enough is enough. While others obsessed over how to get in, Livermore obsessed over how to get out. He understood that the exit was where the story of every trade was written. The market rewards courage on entry, but it pays discipline on exit. The beginner focuses on catching the move, the master focuses on keeping the profit. Livermore knew the market was a stage filled with noise, excitement, fear, hope, greed, and the trader who could step away before the music stopped would always be the one left standing. To him, perfection was a myth. No trader ever sold at the exact top or bought at the exact bottom. The goal was never perfection, it was preservation. Livermore said, "There's a time to go long, a time to go short, and a time to go fishing." That final part, the time to go fishing, was where most traders failed. They didn't know how to stop. They didn't know how to step away once the job was done. They believed more was always possible, and that belief was the silent killer of profits. In Livermore's world, the real victory was not in making a fortune. It was in keeping it. Every trade was a test of patience, not just to enter at the right moment but to exit with clarity. He often said that money was made by sitting, but that didn't mean sitting forever. It meant sitting until the reason for the trade no longer existed. The moment the rhythm changed, he was gone, not emotionally, but mechanically. His exits were not random, they were rules. Define your exit rules before entry. Livermore believed that if you didn't know when you'd sell, you had no business buying. Every trade began with a pre-defined plan, the point to take profits, the point to cut losses, and the conditions to scale out. He treated these levels like guardrails. Without them, emotion would drive every decision. Before pressing buy, he had already answered the most important question: where will I sell? That single act separated him from the crowd. The amateur entered with hope. Livermore entered with a plan. Watch for momentum fading, not price spiking. He understood that markets speak through momentum, not emotion. When the move started slowing, when the energy behind the price began to fade, he knew the crowd was getting tired. Most traders get hypnotized by new highs. They see price rising and assume strength, but Livermore saw exhaustion. The final stage of every rally is not driven by smart money. It's driven by the latecomers, by those afraid of missing out. He sold into their enthusiasm, letting them take the risk he was done carrying. The key wasn't to wait for confirmation, it was to act before the crowd realized what was happening. Scale out before the crowd realizes the move is over. Livermore rarely sold everything at once. He believed in scaling out, taking profits in stages, securing wins as the trend matured. That way, he stayed emotionally neutral. Even if the price went higher after he sold part, he didn't feel regret. He still had skin in the game. And if the market reversed, he had already locked in enough to stay calm. That balance, between conviction and caution, is what kept him alive through every boom and bust. Scaling out wasn't just a financial tactic, it was psychological protection. It kept greed and fear in check. His discipline came from pain, the pain of watching fortunes vanish when he ignored his own wisdom. Livermore lost millions not because he didn't understand the market, but because he sometimes forgot to listen to his rules. And each loss brought him back to the same truth: the exit is everything. A bad exit can turn a good trade into a disaster. A good exit can turn a bad trade into survival. Success in trading is not defined by how often you win, but by how well you protect what you've won. He saw exits as the punctuation marks of a trader's sentence. Without them, your story never ends. It just drifts into chaos. The exit gives meaning to the entry. It turns risk into realization. That's why Livermore planned his exits with surgical precision. He wasn't trying to impress anyone with how long he could hold. He was proving to himself that he could control when to let go. That was his real power, control. As the years went on, Livermore's philosophy became less about markets and more about mindset. He realized that trading was not just a financial game, it was a spiritual one. Every exit was an act of discipline, a small victory over greed, a quiet acknowledgement that enough is enough. To sell at strength required courage, not the kind that shouts, but the kind that walks away without applause. The modern trader can still live by his principles. Before you ever enter a trade, write down your exit plan. Mark the level where you'll take partial profits. Decide on the signal that tells you the move is slowing. Promise yourself that when the market gives you your target, you'll take it. Not because you fear missing more, but because you respect your system. Trading isn't about being right, it's about staying consistent. The market rewards discipline disguised as detachment. Livermore's legacy is simple yet profound: the money is made in the exit, not the entry. Anyone can open a position, but only a professional knows when to close it. The difference between fortune and failure often lies in a single decision: to sell while you still feel good about it. The greatest traders are not those who hold the longest, but those who leave the smartest. So the next time you're staring at your screen, watching profits climb and emotions rise, remember this: you don't need the top tick. You just need to leave before the crowd realizes it's over. The exit is not the end of the trade, it's the proof of your discipline.